Okay, so I'm going to sort of summarise up a bit now. GDP, 12 months too is the black line. The red line is basically the quarterly numbers. I've moved the where does it start through to June. So the number you're about to get next week, we've got a 0.2 in it. All right. So when the press comes out and says the Australian economy stopped, don't believe them. What happened was it was lumpy exports. So the quarter before was 1.2, 1.1%. So you sort of averaged them. But what I sort of get nervous slightly about is the red bars in the out years. Because what's happening there is our growth numbers are going from 3%, and the 3% sort of numbers for this year and next year. Treasury's got it, Reserve Bank's got it. What the Reserve Bank does and Treasury does is they then just put trend in, and they get 3.5. We try and actually forecast it, and what we see is a combination of the LNGs, they went up, and then they flatten out. So from a growth point of view, that's flat. We don't think there's going to be building a lot more apartments in 2 years' time. So then you get left with the economy itself. And what we're seeing there is essentially that we think the economy itself sort of slows to something like 2%, which makes us feel really nervous in terms of what it does. So really, that's sort of summarising it. You can see the red line is the GDP numbers, which is affected by the exports. The blue line is where domestic economy is growing. It's around 1%, and we're hoping with lower interest rates, better currency in terms of competitiveness, that essentially you will continue to improve. In terms of unemployment, we've got unemployment in the black line there running along at about 5, 6, 5, 7. However, if the economy in 2018 is really slowing to something like 2%, that unemployment, unless I did something else, would actually cause me to see or rise, if you like, in unemployment to about 6%. So what I'm sort of saying is I think you need more stimulus. Not now, but in 12 to 18 months' time. And one of the reasons the Reserve Bank can look at stimulus is the following chart. Blue is the inflation outcomes up until the current forecast, and red is the sort of traditional models we run. Our models are the same as the Reserve Bank's. What that graph's sort of saying is inflation, for whatever reason, in the last 6 months or so, has basically surprised everybody on the downside. We think it'll probably continue to... Now, 2 reasons. Number one, the labour market's okay, but there's no increase in wages. Don't really understand why there's not more wage pressure. Number 2, remember the wholesale story? Their margins are being crunched. They don't have an ability to move it along. In the retail space, you've got the supermarkets, you've got Aldi rolling out. Everybody's taking a cut in prices. Looking forward, we don't have core inflation back to 2% until 2018. What's the Reserve Bank targeting? The band there, 2 to 3. So you're a central bank who's targeting inflation, and I'm just telling you for the next 2 years to 3 years, you're going to be below the bottom. So whenever you get any sign whatsoever of unemployment starting to go up, or wages or in GDP starting to look a bit sick, they'll cut. So my final slide is basically got a lot of words in it, but really what it's saying is they're an inflation central, targeting central bank. The inflation is really low. They worry a little bit about the housing market. They probably should be worrying more than they are. But about 12, and if you get any problems with the labour market before Christmas, they'll cut. But I think it's more likely, given the growth prospects, you don't really get an issue until middle of next year. And then what we've done is we've said we think essentially middle of next year they might have to cut down to about 1%, i.e. another 50 basis points. I think from the layman's point of view, the main issue I'm trying to say here is interest rates are not going up. So they're either going flat or down. And we don't have any increase in rates until, I think technically we put something in there in 2019, but basically so far out we can't see it. So if I sort of was going to summarise in terms of Australia, I think it's actually the non-mining sector is doing a lot better than people realise. That means essentially you get very big differences by region and by industry, but the economy is actually performing pretty well. When you talk privately to the Reserve Bank, what they will say to you is the real problem for Australia is a AAA economy, not the rating, it's the economy. Because if you're from the outside, very few economies are growing at 3%, paying interest rates around 2%. Large chunks of the world have got negative rates. You've got unemployment that's not too bad. Despite what you hear in the press, Australia's public sector debt is really low. It's about 19% of GDP. The average is around 90. You get worried about Greece at 160 or Japan at 220. We're 19. We still may lose our AAA by S&P, but that's more about politics. So I'm going to stop there and